Hi, I'm Mark Rosano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network. So today we have our frac spread count, and we're going to talk about the frac spread count. We're going to talk a bit about DUCs because we got the new information from the EIA, and then we're going to go abroad a bit, look at some of the things that are happening on the refined product side, and then round up with what's happening with some rates in the U.S. and do a quick overview of what the ECON show is going to look like next week. So when we look at different things, we want to look at the frac spread count. So we had an increase of 2, so we went from 269 to 271, but it's important to look at some of the things that are happening. So Appalachia came back up, but one of the ones that we wanted to talk about, and one of the things that's unique to Primary Vision, is we capture when we kind of dump into other. Now, if you're getting the data directly, there's a whole tab on what counties are included in that. But I think that's going to be an important one, and that's going to be the differentiating factor for a little bit, especially when you start looking at natural gas and where natural gas is, because a lot of these areas are on the gas side. So I think that's going to be something that's going to be an interesting time. Now, this is kind of like the first push towards the summer high. It started now, the Permian had a bit of a moving day, is what we like to call it. When you look at we had a small drop, but again, you have things moving about, you have repositioning, so it's not something that is going to be in a very short period. So even though you had the Permian coming down, we still had an increase of 2 spreads. And now we're going to have that kind of steady move, as we've been talking about, up to about 290, and then through May, we'll probably, and then really into June, we'll start to get towards that 300 mark, which we think is going to be closer to the high mark at the beginning. And then we'll start to see some additional spreads coming through as we get towards the July month. So when we look at rigs, rigs were up by 2. But the one thing that we always like to talk about, horizontal went up again to 3 by 3. It was most of that was driven by North Dakota, or rather the Bakken. So again, you're starting to see that very consistent move, because you want to see those DUC counts, the drilled but uncompleted wells, available for drilling. But some of the nomenclatures that come out that we keep talking about is everybody likes to look at the total drilled but uncompleted wells, and it's like, oh, it's so low. And don't get me wrong, as you can see, it is low. And a lot of that is being driven by the Eagle Ford and the Bakken. Now, the rate of change is flattening out. We are seeing some stabilizing moves in terms of the Eagle Ford, where we have rigs kind of matching right where spreads are right now. We think that's going to continue. And it's not that we're going to get this big increase, but you're just going to kind of get this flatlining at this point as they go into kind of this full manufacturing mode, if you will. But the ones that we've been talking about as being some of the near-term catalysts for growth is obviously the Permian, which is of no surprise, but also the Haynesville and the Anadarko. So when you look at the Permian obviously has come down to 2017 levels, but you're starting to see it kind of flatten out. It's still coming down, but this is where we see this change, where we're not going to get to where we were in 2016, but you're going to start to see this hold this level and start to flatline. We'll probably have another drop this month, but as we go into May and June, we'll start to see again that flat line out, and things will get a little bit more stable. But then when you turn to some other regions and you look at the Haynesville is already flatlined. So you're already seeing this build up because LNG is robust. I mean, when you look at delivery into Asia, which we have a chart coming up on that, I mean, you're talking about serious pricing power, which is why you're going to continue to see natural gas get that bid. And then when you look at the Anadarko, one of the ones that we've been talking about, you're starting to see that, as you can see here, really starting to level off. And that's where we see that liquids play. That's where we're going to see more activity. We continue to see those pieces. So yes, the total DUC count has come down, but some of the biggest growth areas that we're going to see over the next couple of months have already started to see that kind of build up, if you will, of to prepare for that push as we go through the summer months. Now, this is something that I just wanted to highlight because we talked a lot about it on the EIA show. We were saying that there was a kind of this big shift in Singapore, and we expected it to kind of snap back. And here was that snapback. And one of the things that we were talking about is that you were going to get a build again in the middle distillate It was going to be underwhelming. It was, but you were going to get a bigger snapback in the residual and light distillate side, and that's what we had. And we'll go deeper into that in the EIA show next week. But gas oil continues to be an issue in Europe, and that's when we're seeing a huge kind of sucking sound from India, from the Middle East into the European market, as gasoline is now at an all-time record high. So they're going to start to export. So one of the things, and these are some of the good quotes, I think, Europe's oil product imports from the Americas are poised to surge to 20-month highs in April, driven by elevated shipments of naphtha and diesel. And those are things that I think are going to continue to come on. So elevated arrivals of diesel cargoes in Europe from the Middle East are set to push overall refined fuel imports from the region to an 18-month high. So remember when we were talking about, Singapore, because you kind of get this like backlog, if you will. So you go from the Middle East, Fujairah, all the way around. So now you're starting to see this movement. Instead of going to the east of Suez, you're going to see it going west of Suez, and you're starting to see that move the other way. So when you look about 1.55 million tons or 387,000 barrels a day of diesel fuels are due to arrive in Europe from the Middle East in April, more than double what we saw in March. Now, when you project out into May, it's actually going to be something much greater when you look at where things are going, where it's going to reach something just based on what is so far spoken for. Expected arrivals in May are likely to maintain the momentum, with already 19 tankers booked and that are already set for about 1.14 million tons. So if you think about, in April, we were at 1.55, we're already at 1.14. It's a good chance that we're going to close that gap and actually exceed it because, again, gas oil is still significantly short in Europe, and you're going to see some of those cargoes again moving over. 8 tankers that are underway and hauling 494,000 tons are expected to arrive next month. Again, these are the reasons why we're continuing to see these pivots, and the reason why it's so important is because Europe has to replace Russia in some shape, way, or form. And this is just one of those examples. And when you look at what Russia is doing, you can see that Russia's seaborne exports of crude and oil products appear to be more resilient to sanctions and boycotts than expected. But again, this is a quote from S&P Global. But if you've been listening to us, it's not more resilient than expected. Like, this is exactly what we expected, because Russia has no choice. They have to sell into the market. They have to keep this moving. So they're going to sell at whatever clearing price is possible to whomever is going to buy it, which, as you can see, has still been other areas. But the unknown, or other, as they've been increasing, you can call it whatever you want, but we know it's going into Asia. We know it's going to India and China. But that's how they've been able to maintain it, is they're seeing less and less purchasing from Europe. It's not going to be all at once. And a lot of that will go into the Asian markets. And again, like, that's why, as we said in the EIA show, 30% of India's diesel exports are going into Europe. I mean, that's going to continue because India's going to import Russian, then they're going to export product. Again, Middle East, same thing. You're going to continue to see these flows and these shifts as essentially Europe just absorbs a huge amount of this diesel. Now, the onshore market of China LNG remains high. I think that's an understatement when you look at the surge in pricing, which is why when you look at inflation, when you look at what they're trying to do, we talk about PPI, we talk about CPI, and the huge disconnect. This is where we're continuing to see these disconnects, because cost is just continuing to go up. China gas distributors face more dollar margin compression in 2022. S&P Global Ratings expects entities to continue to scramble to find cheap gas and to pass along their price hikes to customers. Now, but we do know that the governments are essentially struggling in the sense where they're trying to not pass on as much, because they're trying to, again, protect retail sales, which, as we talked about in the ECON show, segment 5, retail sales are under pressure, and this is exactly some of those reasons, because costs are going up, and the government's trying to layer in whatever protection they can, but it's getting very difficult, or I should say expensive. Now, when you look at the U.S. and what we had today, the manufacturing PMI came in above expectations on the flash, coming in at about 59.7. But again, and we'll talk about this more in the Econ show, because With the expectation was for 58, but you had some mixtures in that. These services had a big hit. It was expected to be at 58, came in at 54.7. So the composite, which came in at 55.1, expected to be at 57.9. So but many businesses, and this is when you start looking at, well, why is it still so high? Well, what did we have? So companies are also facing mounting challenges from rising inflation and cost of living squeeze, as well as persistent supply chain delays and labor constraints. Remember, supply chain delays comes in as a positive, but if you look at just efficiency of doing business, it is not a positive contributor, but it's positive to the number. So these headwinds plus increased concerns over the economic outlook and tightening monetary policy, for those that have been watching the ECON show, no surprise there. Business confidence outlooks continued to slip sharply lower in April. But then when you look at hiring, remain relatively solid. But the other key piece to it on the inflationary side is when you look at pricing. So pricing went to a new all-time record on prices paid on the service front. So again, that's just continuing to, even though it's a positive contributor to the number, it's hugely negative and again, a leading indicator for where inflation is going to go. And we got more of that in some of the recent data. So when you look at the inventory components of both the Empire and Philly are still expanding, again, showing that you're getting some of that excess of inventory coming up, some of the supply chain eased, but you're also getting a slowdown in retail sales, leaving more in storage, in inventory. So when you look at the Philly manufacturing index, it came in at 17.6, was expected to be at 21.4. So again, that slowdown that we talked about seeing last month. We're also seeing the manufacturing prices paid, a new all-time record. Again, the leading indicator for where inflation is going, because prices paid, they're going to try to pass through as much of that additional cost as possible. All of that leading to, when you look at new orders are just getting trounced, which again, that key leading indicator that we've been talking about, which is why when you look at new orders, the expectation for business activities continues to come down, because they're looking forward and seeing that their orders are coming down as inventory builds. So again, you're seeing some of those pressure points. Then when you look at that in general, employment component surged to 41.4. So again, staying high, but the 6-month outlook dipped further to 8.2, the lowest since 2009. So you're kind of getting that divergence. So the view is now employment's going to roll over a bit and come under a bit of pressure. All the while, mortgages. So mortgage, the 30-year fixed national average came in at 5.29%. That is a 12-year high. So for those that think that housing is going to be able to maintain the current rate or the current pricing, I think this is a good knock against that when you look at just how costly it's getting. And I think another good leading indicator is the appraisal waiver. So the appraisal waiver is when, for those that have bought a home or are looking, you have to have that house appraised, or the apartment, condo, whichever. And if it doesn't meet the asking price or the price agreed to, then you have to make up the difference. So when we were buying our home, we offered to pay X, and then it appraised $10,000 lower. So again, that became a problem because we were young kids at the time. We didn't have the money. So it was then a struggle where, how are you going to close that gap? So typically in a very hot market, they'll essentially give you waivers where you won't have to get appraised, or if it doesn't appraise at the asking price or the price agreed to, it's fine because the market's so hot, and that's really a lagging movement. But the fact that those waivers are coming down is showing that you're getting some tightening on the financial conditions. You're getting some concerns. So one of the funny things when you look at just inflation, so housing prices are up 19%, rent prices are up 17%, but CPI for housing is up 4.5%. So again, when you look at inflation, the sticky side of inflation, there is still a huge gap to go when you look at the owner's equivalent rent, or the OER, which is the factor in CPI. That's where we're going to continue to see that, again, grind higher. So a lot of fun things. So, the economy's not great, slowing down a bit, but again, it's not, that doesn't matter for activity right now. Activity is going to continue to go up. The problem that we see is obviously steel prices are an issue, as we talked about last week. Proppant prices are going up again. So you're seeing again some of those costs going up, but just based on the three streams, you look at natural gas at $7, LNG prices and demand going up, crude prices over 100. You have liquids prices and natural gas prices at near highs. Again, a lot of this is just going to continue to keep things moving through. So that's what we have for you today. Hopefully you had a relaxing weekend if your kids had spring break and you had a great vacation. Otherwise, we hope you have a great weekend. Thanks again for watching. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.